So now we're starting on chapter 7, and this is problem 7-1b on page 338. And so in chapter 7, we're looking at accounts receivable, which basically means that if you own the business, someone owes you money for services or goods that you've provided. And so we'll start out, first of all, on August 4th. This is our first transaction that we have. And it tells us that we sold $3,700 of merchandise that had a cost of $2,000 on credit to Mackenzie Carpenter. So we have accounts receivable, which is a current asset, shows up on our balance sheet. And we have to note in a subsidiary ledger who owes us that money so that when they pay it, we'll know who to give credit for that. And this is as a result of sales. We've sold them goods in the memorandum to record sales on credit. And I probably won't do a memorandum on all of these. It just takes too much time. You get the general idea. You want to put a description there so that if you look at this a year from now, you'll know what that meant. At the same time, because we sell goods, we have cost of goods sold, $2,000, and that decreased our inventory, $2,000. And we'll go ahead and format this. Okay, the next transaction that happened was on August 10th. And on August 10th, we sold $5,200 of merchandise that had a cost of $2,800 to customers who used their Commerce Bank credit card. And they told us up in the problem that when someone uses a credit card, there's a 3% service charge on sales. And so because of that, we only received cash of $5,044. The rest of that went to credit card expense. And we want to keep up with that separately because obviously cash did not come in for that amount, but also so that as owners of the business or readers of the financial statements, we can see how much money we're spending annually on credit card expense. So that was $5,200. And then again, inventory decrease, which is cost of goods sold, $2,800, that was given to us. $2,800. And then obviously you would do a memorandum. The next transaction happened on August 11th. On August 11th, we sold $1,250 of merchandise that had a cost of $900 to customers who used their Aztec card. And on the Aztec card, we were told in the problem there's a 2% charge. But they did do that on credit, so it's an accounts receivable. And again, it tells us all of this in the problem, because when they use their Aztec card, as it tells you, we accumulate the receipts for several days and then submit it to Aztec for payment, whereas with the credit card, there's an immediate credit to the bank. And that's why we used cash for August 10th transaction. It was immediate, and for this transaction, because it's Aztec and there's a time period where we do not receive that money yet, then we have to show that as an accounts receivable. We still have the credit card expense, which is $25 or 2%, and then sales $1,250. And then don't forget, when you sell merchandise, cost of goods sold, that was given to us. And merchandise inventory decreases. It comes out of our inventory, $900. Okay, the next transaction happens on August 14th. And on August 14th, we received Carpenter's check in full payment for the purchase of August 4th. And so we received cash. We would decrease accounts receivable because they paid that in full. But if you remember, and I'm going to put this in the note here so you can see it, we have a sales discount. Let's see, it's in the problem. Very last things, we have a term. All credit sales are 210 net 30, meaning if they pay within 10 days, they get a 2% discount. And they did get the discount, so we would record cash received less the discount. And the discount would be $3,700 times 0.02%. Now, if you notice, this is what's called the gross method. In other words, we recorded it up here at the gross amount. We did not net the discount in the original entry. We waited until they paid it to give them the discount. And so we would call this sales discount. And $3,700 times 2% is $74. The difference is $36.26, and we decrease accounts receivable $3,700. Next transaction was on August 15th, and on August 15th, we sold $32.40 of merchandise that had a cost of $17.58 to customers who used their Aztec card. So again, because it's not an immediate transfer of funds, we do accounts receivable Aztec, and it was $32.40. Oh, I'm sorry. It was, let me take the credit card expense. So that is the $32.40 times 0.02%, or $65. And then we have sales of $32.40. So the difference, $32.40 minus 65. There we go, $31.75. And then that merchandise that we sold had a cost of goods sold of $17.58, which decreased our merchandise inventory, $17.58. Okay, moving right along, the next transaction happens on August 18th, and on August 18th, we submitted Aztec card receipts accumulated since August 11th to the credit card company for payment. We didn't receive payment. We've already recorded accounts receivable, so there's actually no entry here, nothing that we need to do at this point. And then on August 22nd, we wrote off the account of Craw Company against the allowance for doubtful accounts. And I don't think we had established an allowance. They haven't given us that information in this problem. We'll do that later. But we have an allowance for doubtful accounts that we keep funds set aside, knowing that some people just don't pay for whatever reason. So we write off the accounts receivable, and that is Craw Company. And we write it off to that allowance account so that we can keep up with that in our financial statements and have a record of that. Then on August 25th, we received the amount due from Aztec. And so we received cash. If you go back up, you can see how much they owe us that I happen to know. It is $4,400. And so we'll go ahead and book that right there. Okay, that's all of problem 7-1B. And in the next video, we'll move over into 7-2B.